Good morning, everyone. My name is Kerry Kantin. I'm the U.S. Bureau Chief for Lebanon Insights. We are here this morning to discuss topical issues and covenants in Q1 in leveraged loans and high yield bonds. I am joined today by a couple of my colleagues over in the covenant review side of the business.
Hi, I'm Anthony Canale. I'm the Managing Director and Global Head of Research of Covenant Review, and I'm joined by my colleague Jessica. Jessica, want to introduce yourself?
Hey everybody, I'm Jessica Reiss. I head up the U.S. Leverage Loan Team at Covenant Review. And welcome.
Well, welcome, everyone. As we all know, the first quarter started out on a really strong note, but by February, AI disintermediation fears, rattled particularly the loan market. And then with the Iran war starting in March, market conditions became choppier. In addition to having leverage to push back on pricing, another topical issue particularly for certain credits, was covenants. One situation in which the covenants got a lot of attention was sealed air. Tony, do you want to walk us through what happened?
Happy to, Carrie. So what happened with Sealed Air is, so a CDNR affiliate came to market with an offering of nearly $3 billion of secured notes due 2033 and unsecured due 2034, multiple tranches, obviously to provide a portion of the financing for the LBO of Sealed Air by CDNR. These notes contained a glaring new innovation. So a carve out to the restricted payments covenant for something called a permitted business line distribution. This carve out would basically have allowed the company to spin off any business line that represents less than 50% of the EBITDA if it can meet a 5.5 times or no worse first lien net leverage test pro forma. So on its face, this is a really broad carve out. This means this carve out would have codified what happened in PetSmart and Chewy. So in that case, an extremely valuable portion of the business, but a portion of the business that represented negative EBITDA was able to be diverted away from creditors. Spinning off a negative EBITDA business is always going to result in a leverage ratio being no worse pro forma for the spinoff. That means this business permitted business line distribution carve out would always be available to transfer any negative EBITDA or pre-revenue business in a spinoff to the sponsor at any time. And that would be true regardless of what is the fair market value of the business line being spun off, its importance to the issuer's business taken as a whole, or the importance or value to creditors of the credit support that's being provided by that business line. So you can see the language on the screen in our slides. And the upshot of this is we published a market alert, which is what Covenant Review typically does when we see some new and innovative language coming into the market to highlight highlight this flaw to the entire asset class. We put that out on March 30th. The next day, CDNR caved and they took that carve out of the bonds, among other changes. Now, of course, this doesn't mean that the company can't spin off a negative EBITDA business under the covenants. It just means it needs to find enough capacity to do that under the other provisions in the document and not just use this one broad carve out the way it had initially served it up. So, Carrie, on that note, can you think of any recent loan transactions where we saw meaningful pushback?
So another transaction that did see significant documentation changes. And if you look at Covenant Review's composite documentation score, this was the deal for Arglind. They're backed by TJC and they were acquiring a couple of assets from DuPont. The structure saw numerous changes. There were also changes to structure and pricing and whatnot. But in this case, the composite document as proposed, it was a 4.5 and it moved to a 3.84. And that was actually the largest change, like in magnitude of doc score since Q2 2025, which perhaps not coincidentally was another period um, uh, with volatility and investors had the ability to push back on terms. In this case, there were numerous changes. There were LME protections added. Numerous baskets and ratios were tightened, enhanced the MFN protection. And this was one of the deals also in which, that included a high watermarking provision and that was eliminated. So that was another notable, you know, documentation, issue for a new issue transaction. Jessica, what would you say are some of the biggest pushback points in US loan docs these days?
Thanks, Kerry. I mean, you already named a couple of them. Um, and I guess I'll caveat this by saying that whether documents actually flex really depends on, the time of the market, the type of the deal that's being done. Rescue financing is obviously a lot easier for lenders to kind of push back against the more aggressive or flexible points that are being raised by the borrower or the sponsor. One that you just mentioned, high watermark EBITDA, which was, I feel like very popular in US loan docs, or at least tried to get into a lot of US loan docs back in, let's say, the summer of 2024. Which basically means that at any time, if 4-quarter EBITDA or trailing 12-month EBITDA is higher than at any point, before or after, all of the baskets are going to be reset to, be deemed to use that higher EBITDA, even if EBITDA subsequently drops. We did see that added in a number of deals, and it continues to be flexed out very regularly. I would say, I think the last time we actually saw it added in a new document and actually stuck in that new document in cleared market was October of 2024. That doesn't mean that backing up, that sponsors have not tried to keep putting it into documents. We do continue to see it pretty regularly, and it seems to be one of those points where lenders have really banded together and pushed to have that flexed out. Also, to your point, we're seeing a lot of LME related protections being added. So, going from majority lender consent to incur priming debt, assert a blocker of affected lender consent is being added in a lot of cases. We're seeing more blockers on the ability to transfer material IP. The J. Crew blocker becomes, some deals start or launch without it. And sometimes they get added and sometimes the deal launches with it and it's maybe very narrow and, there's lender pushback and we see that expanded to be more preventive and more protective of lender rights and prevent value leakage. And just kind of a more general one in terms of, we always see pushback on the size of baskets. You know, if you look at our trendlines reports, you can see that very steadily over the last several years, for general purpose debt incurrence has increased over time. Capacity for investments in unrestricted subsidiaries has increased over time. Part of that is through pick your poison, which is kind of the flexibility to take capacity from a dividend basket and use it for debt incurrence or investments. But part of that is just that we see baskets getting larger, and we have seen real flex in making those kind of somewhat more restrained over time.
Thanks, Jessica. Tony, what are sort of some of the top pushback points in high yield?
Well, it's going to echo in large part what a lot of Jessica just said. I mean, pick your poison, I think, is generally a big one, mostly because of a lot of variations in that provision. I mean, generally, the way it's used, it's think about it conceptually, is it generally builds a bridge from the restricted payments covenant capacity and investments capacity into debt capacity, incremental debt capacity, and incremental secured debt capacity. So if 10 years ago people were asking you, hey, could they prime me with new debt? You were looking at the debt liens covenant, but with a pick your poison provision, you might also be considering restricted payments capacity that could migrate across to the debt and liens covenant. But I would echo what Jessica just said in that generally people are focused on the size of various baskets in the debt, liens, restricted payments, covenants, the permitted investments definition, basically the kind of provisions that are going to facilitate drop downs, up tiering, other LME structures. I would also note that these are all essentially pricing terms. You tend to see in a hot issuers market, a lot of these aggressive provisions are sailing through and eventually are considered to be market provisions. Although there is room for pushback on the really egregious innovations like sealed air. So that was a great example of something new that came to the market. It's really egregious, and that can result in pushback if we can create broad market awareness. That's why we routinely publish market alerts when we see something new trying to be pushed on the market. So I would say overall, in addition to that carve out we discussed on sealed air, that deal was a good example of the kind of pushback there can be for really aggressive covenant sets. CD&R's covenants are generally considered to be really aggressive and one of the most aggressive packages out there. Among other things, and on top of the permitted business line distribution carve-out we talked about before, we saw other changes in the sealed air bonds. The ability to secure pick your poison debt from under the liens covenant was removed. The debt covenant typically for high yield debt, the ratio test is going to be set at a 2 times interest coverage ratio. Some of the more aggressive deals try to market it with a lower than 2 times interest coverage ratio. Sealed Air initially served up a 1.75 times interest coverage test rather than the 2 times market standard. That got flexed back to the customary 2 times due to the investor pushback. So a good example of give and take there in a deal where the investors got engaged. So we have a poll question that we'd like our audience to participate in. We'd like to know what you guys think about what you're seeing in the market. Of these covenant terms, which of these covenant terms would you think are your top pushback points within deals that you're seeing in the syndication process? We'd ask you to pick 3 of these. And obviously there's a lot of bad stuff in this thing that we've seen, and some of them are more frequently observed than others. But we'd love to hear what you guys think about this.
Yeah, so I think while everybody is taking a look at the poll, yeah, I mean, I think between what Tony and I talked about, most of that's here. I mean, anti-co-op is one that we had not really raised. We have seen it launch in a few deals. I would say that it hasn't cleared the US broadly syndicated market. I mean, we have seen it in a couple of places. For example, the one that I think most about is Optimum Communications in their unsub deal that they did in November and then amended and restated back, I believe, in January. That's a pretty egregious version, at least from, the perspective of lenders, where not only are are the lenders required to not be in a co-op, they're required to rep that they're not in a co-op on a periodic basis. And if that particular lender doesn't actually respond to that request, they can, they're not permitted to be paid until they actually respond that they're not in any sort of co-op. So that gives the company a lot of control there. Again, that one is, it's a public filer. All of these documents are on Edgar. I'm not sharing anything that isn't out in the market. But I would say, that's still, it's not a syndicated deal. So anyone who was in that deal saw it, knows that language is there, but we have yet to actually see it clear in broadly syndicated land.
I would briefly note that we're going to talk about Warner a little bit later, but on the high yield side and the bond side, the only deal we really observed this clearing was in the Warner Brothers Discovery consent solicitation from last year. So other than that anti-co-op language, we really haven't seen it clear into a bond deal.
Agreed. I think the last time we saw it proposed in a regular new issue transaction was a Heidrick and Struggles LBO, which we reported on, which was in Q4. All right, should we take a look and see what some of the poll selections are?
Okay, it looks like we're all pretty consistent with it, which is validating for us. Thank you, audience. Yeah, I mean, the LME protections, and we put out a lot of reports and we keep a lot of stats on these. This is one where, I think every day there's a new iteration of liability management potentially out there. It's really hard to plug all the different holes. So we do see a lot of both on the on the sponsor corporate side, we see a lot of new ways of writing things. And on the lender side, we see a lot of new ways of kind of plugging some of those holes. But yeah, high water mark we talked about, anti-co-op we talked about.
I think also another angle that we want to make sure people focus on is it's not just the provision itself in the document, but it is what does it take to amend that provision? Like to the extent that you can get 51% of the people to strip out a provision that is a protective provision, you're at risk. So does something rise to the level of a sacred right? I know there was a lot of that done in the Xerox 1L and 2L bond deals, but again, even then there was some structuring around that. So these are big considerations, and everybody's right to be focused on LME protections, obviously a hot button issue.
The one that I find interesting is not many people are concerned about MFN protection. I think that's probably a function that it's kind of almost gone the way of the quarterly tested maintenance covenant. You just don't expect to see it. So I think that's an interesting one as well. There have been so many, death by 1,000 paper cuts to MFN over the last few years. But yeah,
yes, I definitely agree with that, Jessica. Although I will point out, I was going to mention this a little bit later, but I'll mention it now. that we did have one interesting thing in Q1 was we did actually have a borrower trip the MFN protection in Q1, which was something I couldn't remember since 2022, which was also another post-Ukraine war volatility. There was a deal for Select Medical, and it was a private that didn't trigger a change of control because the buyers were carved out as permitted holders, and they layered in $1 billion incremental, and they had 50 pips of MFM for life. And as a result, with the new deal clearing at S plus 300 at 99, I believe the existing 200 paper is going to get moved up to S plus 272 when the deal closes. And it was something I hadn't seen in quite some time. So I thought that was an interesting development. One other thing I want to talk about is, and we're talking about, aggressive provisions being flexed out. But there were also a couple of deals, self-help type of A&E refis in Q1, in which sort of one carrot offered to lenders to, extend or refinance into a longer dated facility was a meaningfully tighter document. And I think this is an interesting topic because while it's nothing new, my colleague Steve Miller recently published something looking at the 2025 transactions, and in these sort of self-help style A&Es, covenants on average did tighten. But I think as we look to kind of address some of the upcoming software maturities, one thing, the sell side has sort of batted around is, hey, if you offer, a meaningfully tighter doc, that could help, get a maturity extension. So the two deals that we picked up on were Dexco, and that score went from the 2021 vintage deal was a 4.49 um, composite doc score. And just for those of you who aren't super familiar with the doc scores are on a scale of 1 to 5, 1 being the most protective, 5 being the least. And then it moved to a 2.85 preliminary. This involved adding a bunch of LME protections and tightening up a bunch of baskets. The other one was Stats, which is a tech deal, which went from a 4.05 to a 2.7. That transaction, also worth noting, did involve Intel kicking in new pref as well. So it wasn't just, the documentation. Both of these, I think, would overall increase pricing for first lien lenders. It's a little bit of nuance with these stats because they went to an all senior structure, first and second lien. But so I do want to raise that because I think that could be something interesting as we move in, into Q2, and we could see more issuers addressing, near-term maturities. So that is a topical issue. You know, Portability. This hit was sort of a top pick in the slide. It's we've had a ton of issuers put in place portable capital structures over the past couple of years. I believe the 15 that LFI tracked last year was the most we had seen in any single year since we opened our doors in 2016. This activity seems to have slowed somewhat, however, amid the volatility. I know you can't name names, Jessica. I can jump in with some names later, though. But what are some interesting trends you've seen on this?
So portability, a portable cap structure, just for those who aren't familiar, it essentially allows a change of control without a change of control. So we see these, there are a couple different flavors of them. It's very common in, for example, project deals, power space, but those are kind of more, once the project is built, someone, a new sponsor comes in and runs it, which is not really what we're talking about when we talk about portability. We're more talking about sponsor to sponsor deal. And Kerry mentioned Select Medical, where, there was a take private. And then it wouldn't have, similar to that, it wouldn't have changed, created a change of control because the management that was taking it private was already a permitted holder. This is a bit different in that the new owners are not permitted holders on day one, but there is this optionality for a new holder to come in, also called a permitted change of control, acknowledging that it is a change of control. There is new management. We see these, I would say, in documentation really in fits and starts, but to Kerry's point, over the course of 2024 and 2025, we're actually pretty consistently seeing, a couple of these every month rather than, you know, I would say like typically we would see 4 or 5 clear the market and then there would be nothing. And then, 6 months later, another deal comes to market with a portability clause. And if that passes muster, then, a few more will come. What we've seen, there's really a lot of differentiation across these in terms of what the terms and requirements are. And you're almost always going to see, some sort of a KYC, know your customer provision, making sure that, whoever is coming in is, somebody who is engaged in, a related business, that they have no real concerns, that they're putting in a certain amount of equity. Generally, we're seeing, I don't know, 30 to 40%, I would say, of the purchase price. But where we see a lot of variation is around, how many times can this be done? Usually it's once in the course of the lifetime, but we've also seen deals that have said, they don't put a cap on it. So in theory, the company could change hands 2 or 3 times during the life of the deal. There's typically a sunset on when this has to be exercised, usually call it 24 to 36 months. But again, we're seeing deals where, there's really no time limit, which has made things a lot easier, I think, from the sponsor side, as maybe there is more volatility in the market. They're trying to, sponsors are trying to make their exit. And, depending on how tight these parameters are, or how loose these parameters are, rather, it does make it easier for those sponsors to kind of make this transfer, where maybe they wouldn't otherwise be able to do, an open sale or something like that on the market. So there's a lot of differentiation in what we're seeing. Sometimes baskets will restart, any capacity is deemed to have been, refreshed, or a builder basket is deemed to have accrued nothing, regardless of how much has already accrued. So there are a lot of different pieces in play here. Ratings requirements sometimes, but not always, et cetera.
Thanks, Jessica.
If you want to name some names.
No, and another interesting thing too that granted interest rates have come down somewhat, but a lot of the deals that were inked over the past couple of years included considerable headroom based on closing leverage to layer in additional debt. And so just so essentially the point is, just because someone's using portability doesn't actually mean there won't be incremental debt placed in connection with the transaction. So that is an interesting situation. And another thing I'd like to just speak to around portability is we have seen, now granted, unfortunately, the optimism that 2026 was going to be a big year for M&A LBO business, that is kind of fizzled out between both sort of the software tech AI fears and the war. But we have seen a few issuers utilize the portability. There was One Digital late last year, and then Paradigm and Sabre Industries this year. And there's another one, I'm assuming these deals get signed, that Bloomberg had reported, I believe it was a few weeks ago, that AKR was looking to sell Atlantic Aviation, fixed base operator, to Apollo for like $10 billion. $10 billion. And that was a portable cap structure put in place last summer. And that is an example of a transaction in which I want to say it was like 5-1, like all senior, and they were able to. A lot of this was granted like junior or second lien debt, but I want to say like the cap was like 7x. So that transaction, if that does get signed, I'd be very surprised if the incoming sponsor doesn't take advantage of the portability, especially because the deal, I mean, it's a very well-regarded credit, but it's like currently a B2 at S plus 250. So, it's a very attractive interest rate as well. There's also a transaction that's reportedly in the works for Cumming Group. Leonard Green, according to the FT, is, I guess, looking to buy them. And our understanding, this is a private credit thing, but our understanding is the borrower currently has in place a portable unitranche. So that's another instance in which it could be used. We discussed the Select Medical transaction earlier. There was another LBO in Q1. I believe it was Leonard Green's acquisition of Mr. Car Wash. that also didn't trigger a change of control. And then Clear Channel Outdoor has, obtained some change of control orders for its upcoming LBO. So there's definitely a been a bunch of new sort of deals that don't involve, existing debt being repaid. So now moving on to another very topical issue is kind of, some distressed situations. And, after there were a flurry of LMEs kind of earlier in this decade, market participants are expecting more previously restructured deals to come back to the negotiating table. We've already seen a couple of them, like Pretty and Packaging and United Site Services. I believe they actually both filed after prior LMEs. But Jessica, you want to talk about how much the docs change from a 2021 vintage LBO or whatever that restructures? What is the sort of the post LNT document?
Sure. So this slide here gives a very, very stark example of exactly what happens. We haven't updated this yet for Q1. We tend to do this slide every 6 months or so just to make sure that we have enough deals, quite frankly, to really make the slide worthwhile. But what you can see here, the left-hand slide, and to go back to our doc scores that Kerry already referenced, 1 again being the tightest and 5 being the least protective on the scale. The dark blue bars are the pre-LME scores for the transaction, and the red are the post. So you can see in most cases, on average, certainly in every case, we've seen significant tightening here. And what that looks like, again, to go back a little bit to some of what we talked about earlier in the presentation, baskets have tightened. LME protections have been added where perhaps they weren't before. And again, in some of these 2020, 2021 vintage deals, they really predated a lot of these blockers that we've seen against value leakage. And again, towards, with the eye towards protecting against value leakage and LMEs. So those weren't there to begin with, which also facilitated a lot of these transactions happening. The docs were a lot more flexible. So this is kind of a bit of, all right, well, we've done this once. Now the lenders are not going to let us do this again. Things are getting tighter. We've seen a lot of cases where either capacity for investments on the restricted subs is either significantly tightened, or the ability to designate an unrestricted subsidiary is just cut off regardless, and that becomes a sacred right to change. Or in some cases, an event of default, if the company does create an unrestricted sub, sometimes it's a springing maturity trigger, for example. We'll see this extend to non-guarantor restricted subsidiaries, where we've seen, essentially free flow of value in a lot of these sponsor deals from, in a loan, which is, has collateral. In a lot of these deals, there's no limit on how much, in theory, how much collateral could be transferred to a non-guarantor restricted subsidiary. Hey, we're all restricted subs. We're all subject to the terms of the credit agreement. We can move assets pretty freely across our subsidiaries. We've seen that tightened up as well. Stripping out the pick your poison flexibility. In some cases, we've actually seen a maintenance covenant added. Sometimes it's a liquidity covenant. It really depends on kind of what the deal looks like. But again, all of these things added together really tighten up the documents. And then just to look at, illustrating this, in the chart on the right-hand side, this is turns of capacity measured, as multiples of EBITDA for capacity for debt incurrence, for dividends, and for investments in unrestricted subs. And what we've seen here again, this just illustrates exactly, what was permitted before versus what was permitted after. This is again, on an average, but really, really significant tightening of flexibility for the company.
Great. Thanks, Jessica. And what do we think this could mean? So are we expecting to kind of see more, as some of these names that previously restructured, some of these names that kind of hit headwinds again, what do you think this could mean going forward?
I mean, it could mean a couple of things. I mean, there are always, like I said earlier, there are new ways of kind of maneuvering that we see in documents every day. Shout out to, law firms and people who are still in practice. But uh, it also, we could see a lot more deals that are more like the traditional bankruptcy filings or restructurings. I think it kind of remains to be seen. Um, we're kind of on the lookout for all of the above. There are definitely companies that have, gone through, multiple layers or multiple iterations of liability management and, so far living to tell the tale. So something that we are certainly keeping an eye on.
Thanks, Jessica. So to that end, tightening the document isn't necessarily a bulletproof solution. Um, Tony, can you walk us through what happened with Xerox?
Happy to, Kerry. And you're right, Xerox is a fascinating case study because even though you had some meaningful protections in the existing credit agreement and the new 1L and 2L bonds, it really is a testament as to how really clever lawyers can engineer around those tight restrictions. We've written recently about 3 separate special reports on the liability management that happened in Xerox and the fallout that's coming from it. So to recap for those who aren't following the situation actively, Xerox's existing credit agreement had J.Crew blocker language that would have prevented material IP from being moved to an unrestricted subsidiary. Separately, Xerox's 1L and 2L bonds also had really strong J.Crew blockers and additional language that restricted the ability of Xerox to move assets to a non-guarantor restricted subsidiary. And again, these protections were pretty tightly drafted, and so that the idea of moving assets in a drop-down transaction to a non-guarantor restricted subsidiary or an unrestricted subsidiary were locked up pretty well. So Xerox went a different direction. Their lawyers used a joint venture with certain of its lenders, and the joint venture entity was an entity that was not a subsidiary at all. So these protections apply to restricted subsidiaries and unrestricted subsidiaries. But Xerox said, "Okay, we'll do this with an entity that is not a subsidiary. Therefore, those restrictions don't apply to it at all." And what did they do? They ended up contributing a bunch of IP into it. Our sister company, CreditSights, estimated it was in the range of, say, 490 million of intellectual property. So the credit agreement and the indentures all would have allowed the investment into a joint venture. And what did the joint venture do? The joint venture with its creditors incurred new debt from the JV lenders and then paid a 450 million dividend back to Xerox, largely funded by the new debt that it raised. So everybody was following this, and we received a lot of inbound questions as to whether the company could do it again. Could they do a sequel with a new JV and potentially involving Lexmark IP? And so we published one of our reports that we published was a follow-up report saying that technically they could do that because each of the credit agreement and all of the bonds have replenishment language in the investments provision. This is pretty commonly observed language, but basically it says that investments capacity refreshes from capital that is returned in respect of the investment. So if you look at what happened with Xerox and you say, hey, let's assume that they made an initial investment of IP to the tune of 490 million, and then the JV turns around and pays 450 million back to Xerox as a dividend to the company could say, well, we've only used 40 million of investments capacity under the docs because the 450 million dividend refreshes investments capacity for future deals. So this treatment arguably makes it easier for the company to do similar JV type structures down the road. And once again, highlights to the buy side that, there is, the creativity of lawyers really complicated, to structure really complicated transactions is prolific. I mean, this was a great example of structuring around some really tight restrictions in the document.
Great. Thank you for that, Tony. Before we move on to the next topic, I just wanted to quickly remind everyone there is a Q&A button. And so if you do have any questions for us, please let us know. We can take them at the end. Thanks for the review of Xerox. Another, on the special situations front, Jessica, you alluded to it a little bit earlier, discussed a little earlier, but can you walk us through what's going on with sort of the latest on the Altice USA or now Optimum Communications situation?
I feel like there are so many things that are going on with Optimum Altice, Cablevision, whatever we want to call them. Um, yeah, sure. I can talk a bit about it. So what I mentioned earlier, the company did in November, an unsub facility. They raised money and actually took out their most restrictive term loan at CSC Holdings, which is a term loan B6. They refinanced that with proceeds of a B7, which they then, raised at this unrestricted subsidiary. And then in January, I believe it was, they also took out, they raised additional money at the unsub and then took out a securitization financing term loan that they had put in place over the summer. There is litigation outstanding. What's interesting is that this is litigation that's filed by the company against their creditor group, against the co-op, alleging and arguing that I think it's like 99% of their creditors are in this co-op agreement. We have not seen the co-op agreement, so I'm kind of paraphrasing a bit. But essentially on the grounds that because all of their lenders, because they're backing up, because they have such an enormous amount of debt and because so many of their creditors are in this co-op and are also, make up so much of the broadly syndicated market and the high yield bond market, um, that essentially the co-op has prevented them from refinancing and from getting additional credit and being able to support their or being able to service and refinance potentially their existing debt. It's an interesting argument. I think I am not a litigator and I am not a bankruptcy person, and I am trying to kind of speak as high level as possible on this. I know that some of the trade organizations, for example, the LSTA, filed an amicus brief a few weeks ago, which then has been responded to by the company. Um, Again, something that we'll see where it goes. It's one of these situations where it is a huge company. They do have huge amounts of debt. They do need to do something about that debt as they have more maturities coming up. Um, but they're not wrong. I mean, they do, they, their creditors do encompass a very large portion of the market. And I think on the other hand, though, they were able to secure financing at this unsub in order to take out their restrictive term loan. So I think that's one that we are watching. I am not certainly not the only one watching it. Our colleagues on the CreditSights side are very closely keeping an eye on this as well. But again, it's an interesting situation. There's also, we're also watching Altice France and Altice International on the European side. So there's always something going on with this company that you know the market should keep track of. I feel like they're a very good indicator of new and interesting structures. I'll put it that way.
Great. Thank you, Jessica. Now I think we'll move to sort of what is going to expected to be, a topic over the summer, when the Warner Brothers Paramount Skydance financing eventually does come to market. Structure is still kind of unclear in terms of the new debt. They recently actually put in place a term loan A that reduced the bridge from, I believe, 54 billion to 49 billion. And, the chatter is that it's sort of going to have a charter-like structure where it's sort of IG secured bonds, kind of term loan B, and then unsecured bonds off the high yield desk. However, there was also a meaningful covenant component to this regarding the existing debt in play. Oni, I'm gonna leave this to you to walk us through some possible scenarios here.
Sure. Thanks, Kerry. And this is obviously a huge situation in the market that a lot of people are currently following, and there are a lot of moving parts here. So I'll kind of walk through both silos and then kind of get into the kind of questions that we've been receiving. So on the WBD side, all of those legacy bonds were subject to a consent solicitation in June of 2025. The net effect of that was that they were all covenant stripped. For bonds that became amended notes, there's a covenant put in place that requires WBD to offer to exchange them into a junior lien security essentially by the end of the year. or they have to pay a fee of $100 per 1,000 principal amount. There's an anti-co-op provision. I alluded to this before. It's the first time we've seen it in the bond market that cleared. So the legacy WBD bonds can't enter into what they call a boycott agreement. So there's a covenant in there that applies to them. There are some restrictions on purchases of those legacy bonds by WBD. They can't make certain offers to those bonds for an exchange other than offers that fall within certain parameters. It's important to note that there's no restriction on WBT to offer their bonds, to ask them for consent solicitation. There's no restrictions on the ability of Paramount to offer exchanges to the WBD bonds. We've written some pretty fulsome research on this recently. On the Paramount side of the house, those bonds are pretty vanilla situation. As we called out a while ago when we did our research on Paramount, the liens covenant for those bonds, those have an IG covenant set, and the liens covenant for the Paramount bonds is critically deficient. That liens covenant only applies to Paramount Global. It does not apply to the subsidiaries of Paramount Global. So we explained in previous reports that, hey, there's a way you could structure financing around this because Paramount's global subsidiaries can pledge all of their assets to secure acquisition financing without worrying about the liens covenant, which only applies to Paramount Global. Now, obviously, with the sophisticated parties involved in this financing, it is no surprise to them that there's this glaring deficiency in the liens covenant for the Paramount Global bonds. And the commitment letter makes it clear they have structured this financing to take advantage of the flaw. So if you go through the commitment letter, secured debt at the Paramount Global box is capped at 15% of consolidated total assets. You'll find that on page 2 of the commitment letter. That's not an accident. That is the general carve out under the Paramount bonds. So they're using that capacity and saying, hey, Paramount Global secured debt is capped at that amount. So what's not said is that the subsidiaries of Paramount Global are pledging all of their assets, all of the assets that they need to consummate the financing without any restriction under the Paramount indentures. So tons of client questions about the situation, a lot of exotic theories in the marketplace about what they could do and structure under this. So, the bottom line is that under the Warner Brothers bonds, you don't have a lot of meaningful covenant protections. Remember, they've been covenant stripped. Obviously, they're going to have to address whether or not they want to offer a junior lien exchange for the amended notes in some form or fashion, or whether they want to do some sort of consent or offer them something else in lieu of that. A lot of people are wondering whether or not whether or not they could do something really coercive to harm those bondholders. And the answer is there's a lot of flexibility to structure a lot of really aggressive liability management here. But the biggest question that you have to think about is, who is going to be buying this financing that they're bringing to market? And the biggest question is more of a business relationship consideration. Do you want to be really angering creditors at the same time that you're looking to come to market with a massive financing to do this transaction? So, there's a lot of questions about whether or not you can offer something to the WBD bonds at the expense of the Paramount bonds, vice versa. Are there ways to opportunistically capture discount, push out maturity? And the answer is, for the kind of creative lawyers that are going to be working on this transaction, you pretty much got the whole toolbox available to structure whatever you'd like to structure within some minor parameters. But the real question is the business relationship question. Like, do you really want to do this to the buy side while you're trying to place this deal?
Indeed, that will certainly be an interesting topic this summer. So with that, I want to thank everyone for joining us today. I do want to point you that we do have some relevant articles available on this site, and I invite anyone to reach out to any of the three of us with any questions you may have regarding something we discussed today or not. So with that, thank you everyone for joining us, and have a lovely Wednesday.
These guys.
Thank you.